So you want a guaranteed way to pay for college. Good credit, bad credit, no credit. No matter your situation, Uncle Sam got your back, right? Federal Stafford loans paid for my first year in college. They also bought my first car, my first laptop, my first apartment, and a brand new wardrobe to strut around Little Rock, Arkansas in. There has to be a catch somewhere, right? And there is. As undergraduate students, or parents of undergraduate students, we're looking for ways to pay for college, and borrowing is one of the top ways to do that. But what happens when borrowing gets out of hand? While borrowing may certainly pay for your college tuition, excessive borrowing can put you in a position to where you're going to be in debt. I want to encourage you all not to borrow excessively. There are two main types of borrowing. You have private student loans and you have federal student loans. Now, private student loans are given to you through a bank. These loans are rare and far between, according to an article written by Carla Freed. They do not offer any type of repayment option, and you must have good credit to be approved for them. Then you have the more preferred federal Stafford loans, which are government-secured loans. These are subsidized and unsubsidized loans, which began in 1958 under the National Defense for Education. Unsubsidized loans mean that you'll have to pay the interest on the loans, whether you're in school or not. Subsidized loans mean that while you're in school, the federal agency will take up the burden of the interest, and you won't accrue interest until 6 months once you graduate. Now, also with federal loans, you get different type of repayment options, unlike you would with a private loan. You have options called IBR and IC, and IBR is the income-based repayment plan, and the IC is the income contingent plan, which helps with people with low income or who have undue hardships. Credit is not a factor, and they also give you loan forgiveness options should you take a federal Stafford loan. Now that you understand your loan options, you must choose the best route. And most researchers say that it's best for you to borrow from the government. After review of the loan options, it's clear that federal student loans provide the safest and better options should you need assistance for paying for college. Now, federal student loans offer a cap and can be negotiable on the interest rates. Now, just because you can borrow don't mean to borrow excessively. For example, some people think that they can later on in life file bankruptcy and their student loans will be forgiven or be discharged, and that's not true. Only 0.04% of people who've actually filed bankruptcy has actually been able to get their student loans discharged. That's not 4/10, that's 0.01%. Borrowing too much can make your interest rate higher, especially if you choose to defer your loans until after you graduate from a four-year college. Here recently, the loan rates went up from 3.4% to 6.8%, which is still less than private loans, which are way higher, and they have variable rates, which can change, so you'll never know what your rate is. But with the new Obama administration plan, if you take on a federal Stafford loan, the loan amounts could change, but they can only go up to 6.8%. Also, under the Obama administration plan, according to a woman named Susanna Snyder in an article called 5 Rules on Student Loans, she said that the new plan offers a longer repayment option, which originally you had 10 years, you could pay for 10 years, and then if you pay successfully, then your loans will be forgiven, the rest of your loan balance. But now Obama has extended it to 20 to 25 years, and instead of them taking 15% of your income, they now take 10% of your income. Now, I know most of us, when we get older, we have dreams of owning our own home, starting a family if you haven't already started one, or just being financially stable. According to Bob Willis in his Too Much Student Debt article, recent college graduates carry an average of more than $25,000, limiting their ability to qualify for mortgages, even if they land a job in a market with the unemployment rate of 9% for 25 to 34-year-olds. Now, what that's saying in short is they gave an example of a student who graduated and entered into a job that was making $60,000 a year, and she also was receiving $5,000 bonuses a month. Her payments were $900 a month because of all the student loans, and she deferred. And so now she couldn't even afford to buy a house. She still had to rent, making $60,000 a year. So that's something you want to think of when they tell you your tuition is only $2,500 and you offer $5,500 in loans. Just take the $2,500. You don't have to take more than what you need. Also, if you take more than what you need, it like I said, it increases the amount you owe, and it makes the probability of you going into default more likely. Interest, and then what's also been found is that interest rates have changed for students that go into graduate school. It used to be that they can get subsidized loans. Now they can't get subsidized loans. So the whole time you're in graduate school, you're accruing a high interest rates. And although you may have to take out a loan, there's also ways to curb the amount you've taken out. In order to avoid excessive spending, here are some tips that you can take. If possible, start off at a community college, unless you got a scholarship off to a college somewhere else that will help lower your funds you have to pay out of pocket. Choose a university that's in-state rather than out-of-state to avoid district fees. To minimize debt and graduation, go back to the basic. Apply for aid and scholarships and grants was a suggestion made by Angelica Tan in an article she wrote. You can also do things like take on work study options if they're available. Instead of buying new books, you can purchase used books or go rent them from Amazon or eBay or half.com. According to Kent Snyder, you can work in public service or government, which opens the doors to loan forgiveness, such as you can be a teacher in a low-income school, and after 10 years, they'll wipe the rest of your student debt. Or you can, for 1 year of public service in the National Health Service Corps, can delete up to $37,000 in student loans. 10 years of public service, such as working as a policeman, a firefighter, in the military, or a not-for-profit agency, can also delete your student loans after 10 years. You also want to make sure that your undergraduate borrowing is about what your annual salary would be once you graduate from college. So if you're going to graduate from college and your salary is only going to be $25,000, you don't want to take out more loans than that. That'll keep your loans at a manageable rate and keep you from borrowing excessively. And as unpleasant as this may sound, if you have to, stay with your mom, live with your parents during your first year of college to kind of work and buy some of the things that you need for yourself so that you don't have to take money out of more money than you need out of a student loan. And then also, you'll save thousands of dollars if you choose to pay for your interest while you're in school instead of waiting until you graduate like I did and then paying off your interest. For example, according to Cola Freed in another one of her articles, if you take out the maximum student loan, which is $37,000, for 4 years, you'll only owe $37,000. But if you wait until you graduate, you'll owe $45,000, which is $8,500 more than you would if you just paid the interest while you're in school. Excessive borrowing is a choice. You do not have to take out more than what you need. I've given you legitimate reasons why excessive borrowing is a danger and provided you with doable techniques to avoid excessive borrowing. Think about the family that you would like to once have or that dream car you'd like to purchase. Better yet, think about the struggle you could fall into with unnecessary borrowing, with the unemployment rate and the job market as unstable as it is. Student debt is growing at $3,000 a second, according to Mark Kennerich, the publisher of the financialaid.org. So take a second to think before you borrow excessively. Is it really worth $3,000?